The week is slowly drawing to a close, yet the US employment report for January is still to be released and could alter the current picture of the markets. Yet for the coming week on the monetary front, we note RBA's interest rate decision during Tuesday's Asian session, while we also note from the Czech Republic CMB's interest rate decision and a number of policymakers from various central banks which are scheduled to speak during the week. As for financial releases, we note on Monday the release of Turkey's CPI rates for January, Eurozone's final composite PMI figure for the same month, and Eurozone Sendex index for February, and from the US, the ISM non-manufacturing PMI figure for January. On Tuesday, we get Germany's industrial orders for December, UK's construction PMI figure for January, and New Zealand's Q4 employment data, while on Wednesday, we start with Germany's industrial output for December, Halifax house prices for January, and Canada's trade data for December. On Thursday, we get Japan's current account balance for December, China's inflation metrics for January, and from the US, the weekly initial jobless claims figure, while on Friday, we note the release of Norway's CPI rates and Canada's employment data, both being for January. The USD is about to end the week in the reds against its counterparts, yet the US employment report is still to be released and may change that picture just before the week's end. On the monetary front, we note that the Fed remained on hold, as was widely expected, failing to excite the markets either way. In its accompanying statement, the bank seems to be taking its time regarding the possibility of any rate cuts. Fed Chairman Powell, in his press conference, stated that March is not a base scenario for rate cuts. Please note that the market had already shifted before the release, expecting the first rate cut in May. We tend to be even less dovish and suspect that the bank may start cutting rates in the summer, a scenario that, if materialized, could keep USD supported on a monetary level. On a fundamental level, the unofficial pre-election period is ongoing, with Trump having the advantage, at least in the Republican Party. In the international political arena, the drone attack on a US base Biden was pressured to respond, and such a response could escalate tensions in the area even further. On a macroeconomic level, we note the improvement in consumer sentiment, January, and highlight below 50, implying another contraction of economic activity for the sector, yet the reading rose beyond expectations, sending an optimistic message. The pound is about to end the week relatively strong against the US dollar and the euro, yet weaker against the JPY. On a monetary level, BOE remained on hold, as was widely expected, keeping rates unchanged at 5.25%. The bank, in its accompanying statement, seemed prepared to keep a restrictive financial environment for a prolonged period in order to bring inflation down, and also seems to be targeting inflation from the services sector. Also, it's interesting how the power balance within the bank changes, strengthening the extremes, as we have a first vote in favor of a rate cut, while in favor of a rate hike, the votes are now 2. In his press conference, BOE Governor Bailey highlighted that the bank is not at the point to discuss possible rate cuts yet, underscoring the bank's hawkish tone. The release tended to provide some support for the pound, and we expect the pound to remain supported on a monetary level. On a macroeconomic level, we note the acceleration of the nationwide house price growth rate for January, an indication of a wider demand for the housing sector. On the other hand, the final manufacturing PMI figure came in lower if compared to the preliminary release, implying that the contraction in economic activity for the month in the sector was actually wider than initially estimated. JPY is about to end the week high against the US dollar, GBP, and the euro in a sign of wider strength. On a monetary level, we note the release of BOJ's summary of opinions for the January meeting. The document tended to highlight the possibility of a continuance of monetary easing under yield curve control, as a sustainable and stable achievement of the price stability target has not yet come in sight. The release tended to contradict market expectations for possible normalization of the bank's ultra-loose monetary policy, yet we have to note that there are a number of policymakers still pushing for an alteration of the direction of the bank's monetary policy. On a macroeconomic level, we note the acceleration of the preliminary industrial output for December, yet also mention that the rate failed to meet the market's expectations. On the demand side of the Japanese economy, we note the beyond the market expectations slowdown of the retail sales growth rate for the same month. So the past week tended to dim the picture of Japan on a macroeconomic level. On a fundamental level, we note JPY's dual nature as a national currency and a safe haven for the international markets. The latter may have been a key factor behind the strengthening of JPY, as market worries for regional banks in the US, in conjunction with a drop of US yields, may have produced inflows for the Japanese currency. Should market worries intensify in the coming week, we may see JPY gaining more ground and vice versa. The common currencies are about to end the week stronger against the US dollar, lower against the JPY, and relatively weaker against the GBP. On a fundamental level, we know the political turmoil troubling the EU, especially farmers in Belgium, France, and Germany, who are protesting against increasing costs and the new green policy. Some of the measures announced by the EU Commission, including a limiting of imports of Ukrainian agricultural products and an easing of some green routes, may prove to be insufficient for an appeasement of European farmers. Overall, should the situation be maintained or even escalate, we may see it weighing on the common currency in the coming week. On a macroeconomic level, we note that inflationary pressures in January eased somewhat, intensifying the expectations that December's acceleration may have been temporary. Furthermore, and despite the economic locomotive of the Eurozone, Germany, remaining in a recession for Q4 2023, according to the preliminary release, the Eurozone as such avoided such a scenario for now, as the GDP rate for the Eurozone as a whole ticked up. Nevertheless, we expect growth to deteriorate in the first half of the year due to the restrictive monetary policy of the ECB, and the prospect of a recession seems to be looming over the Eurozone. For the time being, we maintain the view that the ECB is to delay any rate cuts, and it's characteristic that ECB President Lagarde declined to give a timeline for interest rate cuts as reported by Bloomberg, and continue to state that we are not there yet regarding the inflation target. AUD is about to end the week in the greens against the USD. On a macroeconomic level, we note the wide contraction of the building approvals growth rate for December, and we highlight the easing of inflationary pressures for Q4. On the monetary front, we note the release of RBA's interest rate decision on Tuesday's Asian session. The bank is widely expected to remain on hold, keeping rates at 4.35%, and currently AUD/USD implied probability of 94.1% for such a scenario to materialize. Hence, we tend to expect market focus to be placed on the bank's accompanying statement. We would expect the bank to maintain a hawkish stance, implying a continuance of the restrictive financial environment in Australia. Yet the easing of inflationary pressures in Q4 may moderate the bank's stance, and if so, could weaken the Aussie. On the other hand, the CPI rate remains above the bank's inflation target range of 2 to 3%, which may force the bank to remain strict in its hawkishness, and as such, a scenario may support the Aussie. On a fundamental level, we note the close Sino-Australian economic ties, and China's NBS and Gaixing manufacturing PMI figures for January are not exactly encouraging, as Chinese factories seem to be struggling to keep economic activity afloat. Further signals of a failure of the Chinese economy to recover may weigh on the Aussie. Furthermore, we note the market's perception as a riskier asset, and should the market sentiment turn more cautious, we may see it weighing on the Aussie. The loonie is about to end the week stronger against the US dollar, breaking a 5-week losing streak. On a macroeconomic level, we know that the manufacturing PMI figure for January rose, remained below the reading of 50, yet nevertheless, the release provided support for the loonie. Furthermore, we note the acceleration of the GDP rate for November beyond the market expectations, which improved the outlook for the Canadian economy. Yet the release also tended to ease the pressure on BOC to proceed with extensive rate cuts within the year. We note that the market currently tends to expect the bank to proceed with 4 rate cuts within the year, while inflation is nearing the bank's target at a headline level. In the coming week, we highlight the planned speeches of BOC Governor Tiff Macklem on Monday and Tuesday. Should a possible hawkish tone in BOC Governor Macklem's speeches emerge, we may see the CAD getting some support. On a fundamental level, we note the path of oil prices, given the positive correlation with the loonie. We tend to see the case for the fundamentals of the oil market to weigh on oil prices, and in such a case, we may see them weighing also on the CAD. Furthermore, we note that the CAD, as a commodity currency, is sensitive to the market sentiment, and a possible cautious market sentiment could also weigh on the CAD and vice versa. Overall, we expect volatility in the FX market to ease, given that the frequency and gravity of financial releases is expected to ease as well. We also tend to expect the US dollar to relent some of the initiative to other currencies, allowing them to set their course more independently over the coming week. As for US equities markets, we note that the earnings period is still ongoing and could still attract investors. In the coming week, we note the release of the earnings reports on Monday of McDonald's and Caterpillar, on Tuesday of Ford Motor, Spotify Tech and Snap, on Wednesday Alibaba, Walt Disney, Uber Tech and PayPal, on Thursday Philip Morris, and on Friday PepsiCo. As for gold, we note the strengthening of its price, which is in line with the weakening of the US dollar, given the negative correlation of the two trading instruments. Furthermore, we note that the drop in US yields polished the shiny metal even further, as bond investors may have turned their attention towards gold as a safe haven instrument. Should we see the greenback losing further ground in the coming week, we may see gold's price rising further. We hope that you found this report useful. Stay tuned for more releases from all of us here at IronFX. Best wishes for solid trading.
Welcome to another video of IronFX. My name is Emily and today we'll be looking at margin level. So what is margin level? Margin level indicates the health of your accounts. It is the percentage value based on the amount of equity versus used margin. In other words, margin level allows you to know how much of your funds are available for new trades. The higher the margin level, the more free margin you have available to trade, and the lower the margin level, the less free margin you have available to trade. A basic rule of thumb is the higher the margin level, the less possible it is for the trader to face a stop out. Your trading platform will automatically calculate and display your margin level. If you don't have any trades open, your margin level will be 0. So why is margin level so important? Forex brokers use margin levels to determine whether you can open additional positions. Different brokers set different margin level limits, but most brokers set this limit at 100%. This means that when your equity is equal or less than your used margin, you will not be able to open any new positions. If you want to open new positions, you will have to close existing positions first. Hope you found this video useful and interesting. In the next video, we'll be looking at margin call level.
Okay, let's go ahead and get right into it. So as per usual, a risk warning and disclaimer before we get started. So our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie. I will be your speaker for today. I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research from 2019 to 2021. So here's our agenda for today. We're just going to look at some fundamentals first, and then we'll look at some trading strategies for gold, some indicators that you can use, and I've also included some stop loss techniques, so some exit as well as entry rules as well. Okay, let's get started. Feel free to let me know throughout the webinar if you guys have any questions. Just let me know in the chat. Okay. So, firstly, we're going to start off with the fundamentals, okay? So we're going to firstly look at the demand and production of gold worldwide. So starting off with the demand, okay, there are a couple of sectors that are high in demand for gold. If you can see in this chart that I got from Statistica, you can see that jewelry amounts for 55.43%. So, and it also represents the largest source of annual demand for gold per sector. However, this has declined over recent decades, but it still accounts for around 50% of total gold demand. And if we're talking about worldwide distribution, we're mainly talking about India as well as China, which are by far the largest jewelry markets, together accounting for over 50% of the global total. Okay, the Asian as well as Middle Eastern markets are dominated by demand for purer and higher carat gold. Next, we have investment. So because it has unique properties as an asset class, which we'll get into in the later slides. So our analysis shows that modest allocations to gold can actually be proven to protect and enhance the performance of an investment portfolio, which is a sentiment that a lot of investors also follow, because they think that it will reduce volatility as well as minimize losses during periods of market shock. Okay, so investors of all sorts are in recent years coming to accept gold as a reliable, more tangible long-term source of value that has moved independently of other assets. Next, central banks accounts for 11.33%. And gold plays an important part in global central bank reserves, and they tend to be more significant holders of gold. Okay, so since the 2008 financial crisis, it actually prompted a fundamental shift in central bank behavior towards gold, and it encouraged a reappraisal of its role and relevance in reserve asset management. Okay, so just like how we're talking about individual investors, central banks also have adopted this sentiment. So emerging market central banks have increased their official gold purchasing, while European banks have ceased selling, and the sector now represents a significant source of annual demand for gold. And lastly, we have tech. So tech amounts for 8.21% of gold demand. And how it's used in the industry is mainly, okay, there's a broad range of applications, but demand is mainly driven by the electronic sector. So it accounts for about 80% of the gold that's used in technology. The metal is ubiquitous, and most consumer electronics as well as automotive applications, because of its chemical and physical properties, which when combined, it makes it irreplaceable in many high-end devices. Okay, let's move on. So the 2021 gold consumption, this is across a couple of major economies in the world, but you can see that the largest consumer of gold in the world in 2021 is China as well as India, which is what we talked about in the previous slide. As well as China and Russia, which have been the two world leaders in the move to holding larger gold reserves. So this is a pretty outdated graphic. This is from 2021. Okay, so just keep that in mind. Okay, so this is the 2022 gold demand. And 2022 was actually the strongest year for gold demand in over a decade. So yeah, it says here in this chart, 2022 gold demand almost matched the 2011 record. So colossal central bank purchases aided by vigorous retail investor buying, as well as slower ETF outflows, lifted annual demand to an 11-year high in 2022. Okay, it actually saw a total annual gold supply increase by 2% last year. Okay, and this is the 2022 CIC gold production. So China produced 330 tons, Australia 320, Russia 320, Canada 220, and US 180. Okay. Okay. So next, let's talk a bit about how gold is used to hedge against inflation as well as crisis. And with people speculating on an upcoming recession, we could be seeing gold being bought a little bit more in the recent months, as well as in the coming months. Okay, so in this graphic here, we're talking about how gold's value increases traditionally during recessions. So gold has been traditionally considered a safe haven asset for investors when markets are in turmoil. So how does gold hold up when the economy tumbles? Okay, so this graphic uses data from macro trends to highlight gold's price movements during recessions and compares it to the changes in the S&P 500. Okay, so it compares the value of gold to the S&P 500 in historical recessions. So if we're mainly talking about, I think over here, the first recession you see here is the 1973 recession. Gold increased by 87%, while the S&P 500 dropped by 13.1%. Okay, the recession length was about 16 months in 1973. If we look at a more recent recession, okay, I think the most recent one would probably be the 2020 recession because of the pandemic and the lockdowns. So that lasted approximately about 2 months, and the percentage change in nominal price of gold was 5.6% increase, and whereas the S&P 500 dropped by 1.4%. Okay, and here it says gold's price reached an all-time high during the pandemic, briefly hitting the $2,000 per ounce mark. Okay, so since 2022, because the global economy has kind of been shaking with the onset of a couple of wars, as well as countries coming out of the pandemic, as well as facing high inflation, so on and so forth. I'm sure you guys know. So investors are speculating that it might be gold's time to shine in recent years from 2022, even until now, 2023. Okay, but in fact, history shows that gold often outperforms US stocks and the dollar following interest rate hikes after underperforming in the lead up to rate hikes. Additionally, high inflation is eroding the purchasing power of each dollar, incentivizing investment in a tangible asset like gold, as well as other hard assets. Okay, so with geopolitical uncertainty around the world at a high and the US consumer sentiment at decade lows, what do you guys think about how gold will continue to be a safe haven asset as we move on to 2024? Feel free to let me know in the chat. Okay, I'm just gonna continue. Okay, so this is just a gold versus US recessions chart. This is a weekly chart, that just measures gold futures as well as the period of recessions, on a weekly time frame. And then if we look at gold versus inflation, you can see that it's kind of negatively correlated. As the CPI rises, we can see that the value of gold rises as well. Okay, let's move on. So now we're talking about the US dollar relationship. So relationship with gold. So we see here the robust labor market basically indicates that the Fed will probably keep rates higher. There's a high chance that rates will probably not be cut so soon. And if we look at DXY as well as bond yields, they've spiked on stronger than expected employment figures. Okay, however, these moves were short-lived. So gold versus DXY historically have been negatively correlated. Okay, so if you take a look at this chart, for example, if you look from May to September, whenever we see a rise for the DXY, we can expect the gold to drop. And if DXY drops, we can expect the opposite for gold as well. Okay. Next, let's look at the gold versus US 10-year bond yield. So recent ISM data suggests that inflation is increasing in both manufacturing as well as the services industry. But depending on CPI data, we could see some increases, these increases being fed into the CPI data. So once again, you see that the 10-year bond yields are negatively correlated to our gold as well. Okay, of course, this doesn't always happen, so you have to do your own comparisons, and maybe I'll show you guys how you can check out or how you can compare the charts on TradingView. Okay, let me just pull out my charts. Okay, so we're talking about gold. Okay, and if I want to add another chart so that I can compare it right on the same chart, I just press this addition sign and then click on this same percentage scale. Okay, you can of course click on the new price scale, but then you would be comparing on a different scale. So I just like to click on this one. Okay, and you can see yeah, as I've explained before, the DXY or the US dollar tends to be negatively correlated to gold. Okay, so when you're analyzing, you can use this feature. Wait, let me see. Can you guys see my screen? Yeah, okay. Yeah, you can use this feature to basically analyze two charts at once. Okay. Okay, let me know in the chat if you guys have any questions. Okay, if it's all good, let's continue. So now we're going to be talking about the real yield relationship with gold. Okay, so government bond yields are quoted in nominal terms, i.e. the US 10-year bond yield, and real yields are adjusted for inflation expectations. So real yield equals to nominal bond yield minus the expected inflation rate. Okay, now if we look at this chart, this is gold versus real yields. Okay, inverted real 10-year treasury yields. So the interpretation of this, maybe I'll just pop the website into the chat for you guys to take a look at. But the interpretation for this is that the real interest rate is defined as the difference between the nominal interest rate and the expected inflation rate. Okay, so the correlation between real interest rates and the price of gold in this chart is minus 0.82. So basically, when real yields go down, gold goes up. So this links closely to what we've been talking about throughout the webinar, which is that, DXY, S&P 500 tends to be negatively correlated to gold. Okay, but we can see now that real yields are also negatively correlated. Okay, so this correlation explains why inflation is gold's best friend, while rate hikes are probably its worst enemy. Okay, so the reason for this is because rising interest rates also mean rising opportunity costs of holding gold. So gold neither pays dividends nor interest. So it's relatively expensive to hold it in the portfolio when interest rates are high. On the other hand, when real yields are negative, holders of cash and bonds are losing wealth. So investors are more prone to buy gold in that scenario. Okay. Okay, now that we have gone through the fundamentals of gold and understanding kind of the science behind gold, let's take a look at some technical analysis tools that you can use when you are trading gold. So trading gold is pretty similar to trading any other currency. Of course, the only addition is that you should be taking note of your fundamentals as well. The fundamentals that we've mentioned previously. Yeah, specifically for gold. But as for your risk management strategies, they should be about the same as any other currency. Okay, so let's take a look at some trade management strategies. Okay. So the anatomy of a trade, basically you guys know this. This is pretty basic. Your entry, stop loss orders, take profit orders, but it also takes into account your break even, partial profit, idea and validation, trailing stop loss, as well as diversification of your portfolio. So we go through these more in depth in our other webinar series on risk management, but I'll just go through a couple of exit strategies as well as entry strategies in this webinar, and then we'll take a look at the gold charts after this. Okay, so why is it really briefly, why is it important to have a trade management strategy? Firstly, is to control risk. Okay, so trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses and manage their overall risk exposure. Next, we have maximize profits. So trade management strategies such as take profit orders, as well as trading stops that we'll get into a bit, helps traders to lock in profits and maximize their returns. Thirdly, manage emotions. So the discipline and structure that trade management provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Fourth, improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed decisions and avoid the cost and time of having to constantly monitor and adjust their positions. 5, increase consistency. So effective trade management strategies helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so problem with a fixed take profit or stop loss. Okay, so let's take a look at this example. The red area shows a strong resistance area since there have been 2 swing highs in line with this level. Okay, if our trading strategy requires us to have a fixed take profit of 100 pips, we will place the target beyond this strong resistance area. Okay, so let's see how this plays out. You can see price shot up, but it missed it by a few pips before reversing back down. The reason for this is because price tends to reverse off of big areas of resistance and support. Okay, so in an alternative scenario, if we had placed our take profit before the key resistance area, we would have gotten a profitable trade. So it's important to look at the charts and adjust your take profit and stop loss accordingly. Okay, so this is the proper stop loss and take profit placement that we tend to recommend. Okay, so your stop loss, we typically recommend you to place it beyond the major resistance area, and the take profit will be placed before it. Okay. Okay, and this is the reason for it. Okay, because price is attracted to strong areas of Fibonacci. So when we're talking about confluence, here we're talking about Fibonacci confluence, but it could be confluence for anything. So if you're using pivot point levels, if you're looking at dynamic support and resistance by using your Ichimoku or Bollinger Bands, any indicators that you like to use, even your support and resistance levels, okay? When 2 or more of those indicators line up at a specific level, that forms a confluence area. So price is attracted to such areas of confluence, and if your stop loss is right before it instead of beyond it, you will most likely get stopped out before the market reverses. So that's why people might wonder why they got stopped out right before the market starts to reverse and then complain about stop hunting. So if we're talking about take profit, we always recommend you to place it before a key confluence area. The reason for that is because when price reaches the confluence area, there's a high chance that it won't be able to go beyond it because of the amount of resistance or amount of support at that area. Okay, so instead of reaching your profit target, it'll reverse back to your entry or worse, your stop loss. So that's also one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, here's an example to show you why you shouldn't have a fixed stop loss. So this applies for really any trade that you are looking at. It doesn't just have to be for gold. Even if you're trading currencies, it's the same thing. Okay. So here's an example. So here we have a support level with two swing lows that are in line with one another. Price has bounced off this support level and we are expecting it to continue to rise to the swing high resistance. So our stop loss of 100 pips is fixed at the 1894.75 level. Okay, which is at this support level here. Okay, but instead of heading towards our take profit, price actually goes down and touches your stop loss and bounces up perfectly. Okay, so what we should have done instead was to place our stop loss slightly beyond the key level of support or resistance so that we are not stopped out at the support, since price tends to be attracted to key levels of support and bounces off of them. Okay, so let's talk a bit about some entry and exit. Okay, in this case, we're talking about stop loss placement. So exit strategies. Okay, so this is why it's important to have dynamic stop loss and take profit placement. Dynamic stop loss is a trading strategy that's used to manage risk, in which the stop loss level is adjusted dynamically based on market conditions. The level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. So the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trends. Okay, so let's look at some indicators that you can use. Okay, so firstly here we are looking at a simple example to demonstrate a dynamic stop loss. Okay, so price firstly bounced off nicely off of the support level here. So it's a swing low support at 86.721. Okay, and we're expecting it to reverse off of our entry at 87.819. Which is also in line with this 100% Fibonacci projection level. Okay, so we see here that if we're thinking of where to place our stop loss is over here at the swing high, which is also in line with minus 27.2% Fibonacci expansion, as well as the 61.8% Fibonacci projection. And you can see price did rise to our entry and is kind of testing this area here. Okay, so the stop loss should be placed beyond the Fibonacci confluence area instead of before it, like you see here. Okay, and you can see we would have been stopped out if the stop loss was placed at this Fibonacci confluence instead of beyond it. Okay, so it managed to reverse off of it and it's heading back down to our take profit. Okay, so it perfectly reversed off of the confluence area here and towards our take profit. Okay, another example here. So we expect price to bounce off of our entry at 87.625 over here, and the pullback resistance in line with this 78.6% Fibonacci retracement. Okay, and our stop loss is a swing high resistance, take profit is a swing low resistance, support. Okay, so price has hit our entry and has reversed nicely off of it, as you can see here, and is nicely heading towards our take profit. Okay, and then we're using Fibonacci to further complement our take profit levels. Okay, so price just touched our take profit before reversing off of it. Okay, so you can imagine if we had placed our take profit before, beyond it rather, if we had placed it underneath our swing low resistance as well as the Fibonacci level, we would not have been able to catch this before it reversed back up to our stop loss. Yeah. Okay, I think you guys have gotten it by now. Just one more example here. Price recently broke out of this descending trend line. Okay, and we have 3 Fibonacci levels that line up with our take profit here. Okay, and price is currently at our entry. Can see if we place our take profit above the confluence area, price would have reversed off of the confluence area and missed our take profit by a few pips. Okay, so instead of that, we want to place it right below it instead. Okay, so some exit strategies that you can use, which are typically a dynamic stop loss and not just a stationary stop loss or a fixed stop loss. Okay, so trading stop loss. Trading stop loss is a special type of trade order that moves relative to price fluctuations. So we're using a lot of different indicators to support when you should enter or exit your trades. Okay, so when the price goes up, it drags the trailing stop loss along with it. But when the price stops going up, the stop loss price remains to the level that it was dragged to. So it's an order type that's designed to lock in profits or limit losses as a trade moves favorably. Automatic trailing stop loss moves accordingly as price moves favorably. Manual trading stop loss. It's moving stop loss level based on mechanical indicators. Okay, so here are some of the indicators we're using. Okay, firstly, we have you have your moving averages, okay, and then you have your parabolic SAR, or is that, I think that's the chandelier, and then we have the ATR, we have your support and resistance levels, and then this is your parabolic SAR, okay? So let's talk about how exactly you can use them. So trading stop loss is over here, we have a sell entry. So our sell entry, here we're using a moving average, and we can see price is moving, it's breaking out of this ascending trend line. Okay. Here, if we're using a moving average as a trailing stop loss, our entry is here when it breaks out of the trend line, and it also breaks out of the moving average. Okay, so we're using breakouts here, moves under instead of over. You can see moving over here, and then it breaks out, moves under, and then the trailing stop loss is triggered over here. Okay, and it got us out before this happened. Okay, another way is by using trend lines. So here we have a descending trend line. Okay, so what makes a descending trend line, just to recap, is to have 3 significant levels that are touching the line. Okay, yeah, minimum 3. Okay, so our entry is here because price has broken out of this ascending trend line. Okay, and is currently moving in a downtrend. So we have a descending trend line, we have an ascending trend line, and once this trend line breaks out of it, then we are stopped out. Okay, here we're using parabolic SAR. So you see our sell entry is here. Price moves under the ascending trend line, and also the parabolic SAR. You can see it's moving underneath instead of over in this case, until it breaks out of the ascending, or rather it breaks out of this parabolic SAR line. Okay, and then a trailing stop loss is triggered. Okay, here chandelier and ATR. Okay, same thing, sell entry with this line. And we're using both ATR as well as chandelier in this case. So both moving under, and the trading stop loss is triggered once price has broken out of these two indicators. Okay, so this is how we use it in an example. So here we are using Kiwi dollar, but of course you can use it for any commodity, any currency that you're thinking of trading. So once again, we have a price breaking out of this ascending trend line. Okay, it's also moving, or rather it's breaking out of the moving average, and it's moving downwards, or rather it's moving below. Okay, so here we see price moving above the moving average. Once it breaks below, that's a sign that we could see a change in trend. So it's moving downwards. Here is our sell entry, and we're going in for a sell towards our take profit, which is over here. Okay, at this swing low here. And then we are stopped out when price hits this moving average and breaks above it. Okay, last example, dollar CAD. This is a support and resistance example. So we see price once again breaking out of this ascending trend line. So that's our sell entry with our stop loss placed just slightly above, and I'll take profit at the swing low here. Okay. Okay. Now, let's take a look at, let's maybe analyze gold together now. Okay. So I like to start off by looking at the higher time frames first, the weekly and daily time frames. Okay, because then I get an idea of what the general directions are of the trend. So you can see there is an uptrend here, but it looks like there has been a recent reversal. If we look at our daily time frame, we don't have any trend lines or trend channels here. Yeah. Okay, we don't have any trend lines or trend channels, but we can see price definitely moving slightly in a downtrend. Okay. Okay, let's look at our 4 hour time frame. 4 hours is it looks kind of bullish here, even though there is a reversal recently. And let's look at 1 hour. Okay, 1 hour is pretty bearish. Okay, so if you want to compare, let's take a look at DXY. Okay, so if you're not super sure what the directions are, you can always compare with DXY, since we mentioned that DXY as well as gold tends to be negatively correlated. Okay, so we see prices kind of increasing on our DXY. So we can expect the opposite on our gold. Okay, I'm not sure why it's bugging out on me right now. Okay, yeah. So you can see it's moving downwards, whereas DXY is moving upwards. Okay, so let's go in with our support and resistance levels now. Or actually, let's see if we can find any channels. So the first step is always to look for the general trend. So you want to see if you can find any trend lines, which I can see over here. I have a descending trend line with 3 significant touches, as you can see. I can also see that price is moving in this descending trend channel. Okay, so for our valid trend channel, you need 2 touches on top and 2 touches below. And now let's go in with our support and resistance levels. Okay, so I try and pull it back as far as I can, so without cutting too many candlesticks, so that I can see how significant this level is. So here, this is my first resistance. This may be my first support. Okay, and then okay, maybe here. So this is purely graphical, just by looking at support, just by looking at the swing highs and swing lows. Okay, so it's not, you can always go in with your Fibonacci levels and adjust them accordingly. Okay, so now I'm gonna go in with my Fibonacci levels. Here you can see my 23.6% Fibonacci retracement lines up nicely. And okay, my 78.6 also lines up nicely. I think my 100% also kind of lines up with my first support because these don't necessarily have to line up exactly, because they're more so areas than levels. Okay, and I like to get rid of the 0 and 100 if it's not necessary. Okay, let's see what else we have. Okay, my 23.6 lines up with my first support as well. Okay, so you can see that this first support is pretty significant here. Okay. Okay, I think that's all the levels that we have. Now let's go in with some indicators. Okay, price is moving below the Ichimoku cloud, so it's in line with our bearish signals, whereas MACD is giving us a bullish signal. So I'm going to get rid of that. And let's look at RSI. Okay, RSI isn't really telling us much. Let's take a look at moving average, EMA, and SMA. Okay, so price is moving below our EMA, so it supports our bearish signal. And over here, we see that price has crossed over, which signaled a change in trend. And you can see price definitely did drop over here. Price is also continuing to move below our SMA, which also supports our bearish signal. And because they haven't crossed over each other, we can continue to expect that price is going to continue in this downtrend. Okay, but I will say that because there is a confluence area here at our first support, and that's why you see price being attracted to this area, we could see a bit of resistance here and price reacting off of this area as well. So yeah, just keep that in mind. Maybe let's look at Bollinger Bands as well. Okay, on our Bollinger Band, you can see price. Let me make it bigger. Can see price pushing below the lower band of our Bollinger channel, which is also a bearish signal. Okay. So yeah, we could see prices continue to drop here. Okay. Let me know in the chat if you guys have any questions. Okay, if not, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful, and I will see you guys next week. Have a great rest of your week, and see you guys soon. Bye. Thanks, everyone.